Mortgage rates are going to drop in 2023. At least that's what some of the experts are saying. So let me walk you through some of the data, some of the expert opinions, and then I'm going to wrap it all up in a little bow for you with whether or not 2023 is going to be a good time for you to buy and what you should be doing in the meantime. So let's jump into it. Hey, what's up guys? I'm Ben Sun. Welcome to my channel. If you've been here before, welcome back. If this is your first time, welcome for the first time. We don't just talk about this crazy volatile housing market. I also talk about improving our overall financial health through things like personal finance, investing, and real estate. So if that tickles your fancy, you gotta hit that big red subscribe button. Okay, I don't know why I said tickle your fancy, but we're gonna move past that. So let's dive into some of the data to get a better perspective on whether or not we think the rates are gonna drop in 2023. This may get a little bit nerdy, but I'm gonna try to keep it as short and concise as possible, while still providing you with the information that you need to make a better home buying decision in 2023. So bear with me here. So let's first walk through why the mortgage interest rates will not decrease. Now, there are a few things in play that we can't necessarily account for. The first thing is the recent uprising in China. We don't necessarily know how the federal government's going to handle that, and we don't know how it's going to impact our supply chain. It could exacerbate inflation, and it could make it harder for the federal government to correct for inflation, or make it a longer term process to correct for inflation. The other thing is unemployment. The Fed has been getting more and more aggressive about inflation, and they've been using it by raising the 10-year federal bond rate, which has also caused the mortgage interest rates to rise. But they've also said that in order to combat inflation, that they need to raise the unemployment rate. But we don't know how they're going to do that yet, or if they're going to do that. If they raise the unemployment rate instead of the federal bond rate, that could cause the bond market to rally, meaning that the mortgage interest rates could lower. If they create higher unemployment, they could create what's called a job loss recession, which will effectively slow inflation and allow the bond market to rally, i.e. lower the mortgage interest rates. Now, this is not a political channel, so I don't want to get into commenting on the politics of putting people out of work. But I do want to say that I'm not saying this is a good thing. I'm saying that this is a variable that they're talking about using. If they use it, it could lower the interest rates. If they don't use it, then they're going to continue to raise the 10-year bond rate like they've been doing, which is going to increase interest rates, because it kind of has to be one or the other, or a little bit of both. But higher unemployment could mean lower interest rates, and lower unemployment could mean higher interest rates. There are a lot of variables at play, but those are the two main things that are being proposed by the federal government right now. Now, speaking of the 10-year bond rate, the 10-year bond rate influences the 30-year mortgage rate, but they're not a one-to-one comparison. So generally speaking, the 10-year bond rate and the 30-year fixed mortgage rate have about a 1.6 to 1.8 spread. This means that if you have a 2% federal bond rate, you would generally have a 3.6 to 3.8% interest rate on a 30-year fixed mortgage. That's historically how it's always been. Right now, though, we have a federal interest rate of about 3.69% and a 30-year fixed rate of about 6.6%. That means it's a 2.5 to 3% spread. This is literally a historic event. So what does this mean? This means that if things stay similar, meaning that the bond rate doesn't increase, or inflation starts to improve, what you're going to see is that spread, remember it should be 1.6 to 1.8, now it's 2.5 to 3, that spread should start coming down closer to where it should be, meaning that the mortgage interest rates would start to drop. And that's exactly what experts are starting to project. 2023 is going to be a pretty volatile year. You're going to see increases and decreases in interest rate, but generally by the end of 2023, experts are starting to project that it's going to drop from the 7% average that it is today to the 5.5% average or 5.4% that it should be in 2023. Now that might not sound like a lot, but keep in mind that on a $300,000 house, a 1.5% interest rate drop is going to be about $270 per month, or $100,000 savings over the life of the loan. So this would be a pretty giant drop in interest rate. Now keep in mind that housing prices are also starting to correct. So you could very likely find yourself in a much more affordable position. Now real quick here, we have to distinguish that housing values are not falling, housing prices are. They're different in that the value of the home, meaning what it would actually appraise for, is staying the same or going up a little bit. The prices of the home, because of the last 2 years, sellers were able to ask more for the home, or buyers were getting into bidding wars and having to pay more for the home than what it was actually worth. That's coming back down towards even. So you're now able to get a house, or you're starting to be able to get a house for what it's actually valued at, not having to bring more money in. And those two things are really important to distinguish. And obviously still in some markets, like fast growing markets, those things are gonna be slower to react, and you still may be getting into bidding wars because there's a short supply. But it's important to understand that when you hear housing prices are falling, it doesn't necessarily mean that there's going to be a huge drop in value of your home. So let's wrap this all up in a little bow. Is 2023 going to be a good year to buy? And what should you be doing in the meantime? 2023 should be a good time to buy if you're not in a rapid growing market. That could still be okay, but you're going to see inventory issues. And you follow, let's call it the mom and dad, grandma and grandpa philosophies of buying. The first and most obvious is going to be buy a home you can afford. Afford meaning don't go over 35% of your take-home pay going towards the monthly payment. Now is not the time to say, I might get a job raise, or I might get this promotion, and so I'm going to go a little over my budget and I'll grow into the house. Now's not the time for that. It's too risky to do that. The other thing is don't plan on a cosigner. Like, don't get your brother and his girlfriend to cosign with you and then expect them to pay your rent. And if they don't pay, then you go bankrupt. Again, that's kind of always bad principle, but now is especially not the time to do that, because you're not going to have the equity to sell the home, or you're not going to be able to get out of the home as quickly as you might have been able to do in the last couple of years. And on that same vein is, don't plan on buying a home if you're planning on any huge life changes, like moving out of state, graduating college, a rapidly growing family, something like that. A home buying process always used to be where you would buy and plan to hold for at least 5 years. Generally, just because of the market, you weren't going to have enough equity to sell the home, or it would take a lot longer to sell the home. That's always kind of how it used to be. That's why I said the mom and dad's, grandma and grandpa's way of buying a house, because that's kind of what they had to deal with. The last 2 years have skewed how people view buying a house, and how the housing market would grow 50, 60, 70,000 within a couple years, and you could just sell it and make money. It's going back to where you can't do that. You have to plan on buying and holding the home, and it should be a decision that you're kind of thinking about and planning out, because it could take you 90 days or 6 months to sell a home, and you might not actually make any money on it, or it could actually cost you money in realtor fees to sell, because home prices aren't going up like they were in the past couple years. So if you're not planning on staying in the home for 5 years, now is probably not a good time to buy. One of the best things about where we're at right now is that it buys you time. You can start saving for your down payment. You can pay off some of those higher interest credit cards, car loans, student loans, things like that. All of those rates are going up like the mortgage rate. So your credit card rate's higher, your car loan rates are higher. Now is the time to start paying those down. What this is obviously going to do is it's going to save you on your monthly payment and allow you to start building a bigger down payment or afford more house. Lenders go by what's called the debt to income ratio, meaning how much of your income is going towards debt each month. The more you pay off your credit cards and car loans, the more it's going to allow you to buy in home, meaning that a home that you might not have been able to afford a couple years ago, you could potentially afford now. And the time that you have between now and say 2023, mid 2023, end of 2023, when the rates are projected to go down, that's going to allow you time to pay those down and save for a down payment. There are down payment assistance programs. If you want to find out more about those, check out that video up there. And comment down below, are you still looking to buy a home in 2023? Or are you just so fed up because of the uncertainty in the market? And if you got value out of this video, please hit that big red subscribe button. We're just getting started. I got a lot more to come, and I'd love to have you on this journey with me.